covered the population. Look at the size of the banking system as a whole, maybe deposits, maybe the number of clients, maybe the beneficiaries of the banking, and so on and so forth. This is primarily because of 2 or 3 reforms which the moderator narrated on his speech, how each reform step, each step taken by the regulators and the government of India over a period of time, how it has helped the banking system to gain and reach out to the people. Even the setup of new generation banks, that itself is yet another reform which enabled the system to open up and take benefit of the banking system. And therefore, reform should be a continuous process. Reforms have given a lot of advantages to us. The question is whether what has been done is enough. Absolutely not. If you ask me what has been done over a period of 2.5 decades after the reforms, I personally feel that I acknowledge that has been sufficiently been done, but I also say that a lot remains to be done. Lot remains to be done, then perhaps more and more reforms are required. This is on the one side. Then on the other side, how the regulator can play a role in this reform. The regulator has a responsibility, and regulator is necessary, and we cannot say that there should not be no regulations. Regulations are equally important, and the regulator's role should be to balance the effects of the reforms, balance the management of the reforms, and balance whatever is expected to be monitoring of the reform. This is where the regulator has to play a greater role, and I am sure that so long as we take up the reforms greater, so long as we reach out to a large segment of the society with greater reforms in banking, regulators can have a balanced role, and it will be able to get the desired results. I said there is a lot remains to be done. The moderator made a reference to the financial inclusion. Even after so much of reforms, even after 2.5 decades of the implementation of the reforms, today we find that there is still, we are talking about the financial exclusion and the financial inclusion. I had personally an experience, though out of context, I would like to spend a couple of minutes to say how this inclusion is touching the lives of the people in the rural areas. They are craving for a banking facility. He made a reference wherein still 65% of the population doesn't have a normal banking facilities. They are not having a banking account. That is where the financial inclusion was found necessary by the regulator and included as a part of the reform process. Then what happened is, in the process of implementation of this in financial inclusion, what we see in the places where we visit is that people earn whatever possible, keep in the house, and over a period of time, if they are not able to make use of this money, the other members of the family use this money, and that goes off for various reasons. And the reason for their keeping is they do not have amenities or the facilities where they can deposit the money. May not be the branch coverage is not there, bank branch is not there. Now this is all enabled because of again the reforms and the information technology which has enabled this process, and we are one of the banks which have gone in for a branchless banking model wherein through the help of the business correspondents within the framework of the guidelines given by the regulator, we are operating it, and this has been highly successful. And the data is very immensely interesting to see that we find that these people who are not banking with this were in the clutches of the money lenders and paying as much as 200-300% rate of interest to the money they borrow. So in the first phase, what we are doing is we are trying to have them including the banking to the help of the business correspondent. In the second phase, we are bringing them to save money. And in the third phase, once they are habituated to the culture of banking, we are shifting them to give some loans to them to generate some economically self-sufficiency in their living. Over a period of time, I find that in the last 1.5 years, people are rarely coming to take loan, but even they are taking loans, our effort is to see that they are switched over, they are eliminated from the clutches of the money lenders in the phase 1, And phase 2, once we give them the loans, whatever loans we are giving is being used for the purpose for which they are economically generating some activity. All that I am trying to tell you is that despite this reform, this has not taken place. 65% of the inclusion is yet to take place, and the success of the country, the success of the reform, success of the banking activity as such is going to take place only when we reach out to the 65% of the people who are today not using the banking facility. Therefore, there is a tremendous scope for the banking to take off in these areas where banking is not happening. And when former Governor of Reserve Bank of India, Deputy Dr. Rangarajan, I had an occasion to personally take him to some of this, and he was very much interested to talk to these people. Then he asked them this, why did you not open an account? You are about 62 years of age, and you have 6 children in the house. So you are earning so much. Why? Then they were telling that right from morning to evening, we are working in the farms, and we don't have a bank branch here. And if you want to go to a bank branch, either to deposit the money or otherwise, we have to spend one day labor. Number one. Number two, we have to spend for the conveyance charges. We have no amenities available. That is where we are trying to use. And that is why we thought this is ideal. Now that the model which we have given enables them to have anytime, there is a 24 hours, it is not through technology. A business correspondent is receiving the cash from the place where it operates in the village, and then we have given them apparatus which can absorb this receipt, and electronically the data through a mobile phone is downloaded in the bank's core banking server, and the money gets credited to the account. All that I am trying to tell you is that there is tremendous scope, and it is possible for the banks to make a lot of generation of income generating activities, and reforms are required. And one of them, there were a lot of questions, perhaps during the part of the debate I will do it. One relevant question the moderator made is about the deposit insurance cover. Now, there is a fear that some of the banks have lost over a period of time. There is a fear among the people that whether the money is being kept in the bank is safe. In fact, yesterday I was flying back from Bombay, and one of the persons was telling me there are rumors that some of the banks have lost. I don't want to name any of them. Is it safe to keep the money in the bank, and why not the banks increase the coverage of the deposit insurance? Interestingly, I find that there is also a part of the debate today. But I may tell you that 90%, I will repeat, 90% of the deposit accounts in the banking system today are for less than 1 lakh for which the deposit insurance coverage is available. But it represents only 21% of the amount. So therefore, if something goes wrong to any banking system, I personally feel that the number of accounts is more important for us than the amount. I said 90% of the deposit accounts are for less than 1 lakh, which composes of 21% of the amount of the bank deposits. That means if 1 lakh insurance is there, if something goes wrong in the system, there is adequate coverage, and perhaps we may think over a period of time whether we are necessary to do it. I think, therefore, so long as there is a proper balance in the regulation, and reform should be continuous. Because for some accident take place, we should not be shy of driving again. Accident do take place. TAPMI fiasco has happened. We cannot forget what happened in the earlier reform process when Harshad Mehta's scam came out. We also know what happened in the scam of our Ketan Parikh. And what has happened in Satyam cannot be forgotten also. But nevertheless, each scam gives us, and this may be because the risk management system developed and put up by us may not have been adequate enough to absorb these shocks. That is where this has happened. I am sure that with the proper risk management systems, which can form a part of the process, the regulation and reforms can both do well.
Thank you very much, sir. He has thrown some light on, indirectly, on the IT, how it is helping even in the rural areas. Most of us are beneficiaries of this mobile technology and internet and all those things. We do not know that a lot is happening in IT to take banking to rural areas. In the recent times I have studied, possibly the bank is working on those lines. So can we say, Mr. Hire, in that order, Mr. Padsardi will speak, please, sir.
Yes, yes.
Good evening, ladies and gentlemen. Is it audible? 2 observations before I start off on the topic. I thought after the young lady described after the young lady explained the meaning of the word doyen, I had half a mind to withdraw and keep going. And the moderator, Mr. Prasad, said somewhere that Axis Bank is Indian-made foreign brand. So a very spirited remark. Thank you.
In this survey, they have been rated number 1.
You said Indian-made foreign, so I said it's a spirited remark, so that's all. Well, future of Indian banking in view of the global crisis, financial crisis. Where is the crisis? The domestic markets have seen crises continuously. The great big devaluation of 1966, the tremendous oil crisis of 1973. How many of you know that as a result of the oil crisis in 1973, the marginal taxation rate in India at the highest slab was 97.75%. The country has gone through such a phase. And then 2 devaluations against the dollar from 19 rupees to 31 rupees in a space of 7 days in 1991. Your forex reserves not enough to fund 15 days of imports. We were struck with a major crisis. These were on the domestic side, not to speak of the other ones, the market-related ones, which Mr. Bhatt referred to. There have been no less international crises which had their impact on the Indian economy, though not to the same extent as they would have today. For example, LTCM, Long-Term Capital Management, 1997, as late as 1997. Managed and or advised by Nobel laureates in economics, going down the drain. Nick Leeson and Barings Incorporated. Look how rustic a city become today. Or Lehman Brothers, or the very latest, the sensation of this week. What is the truth behind the asatyam of satyam? That's the one thing that's uppermost. So, there are so many things which have happened, which have hit the markets hard. Markets move in cycles. Markets have clearly demarcated crests and troughs. It's not as though we will ride only the crests and avoid the troughs. And this country's banking system has been resilient enough to withstand all these crises. It's not that it has not happened. It's not that it's not going to happen. It may happen. It will happen. But the banking system as a whole is very, very resilient. The origin of this crisis is probably on the excess, the liquidity hang in the global system. When you have too much money, you choose risky assets. You come with what they call exotic products. What can be exotic about finance? It's hardcore money. You can have an exotic holiday. You can't have an exotic product. And many of them are today litigants. And the inadequate measures to contain risk. You don't see whether there is a mismatch between your funds flows and outflows. You have short-term funds and lend on a long-term basis. And you are far too leveraged against your net worth. And your risks are concentrated in particular sectors. And also, there are shortcomings on the risk management side within the institutions. For example, I mentioned about Nick Leeson and Barings going down the drain. Now, this is one case where the dealer was also handling the back office. Now, this is absolute treason or sacrilege. A dealer handling the back office also. It's a collapse of the risk management procedures. And these sort of crossing the line activities lead to risks which ultimately have their domino effect on the markets. Coming to capital regulation in India, I find the spectrum of banks very interesting. Today, the Reserve Bank of India says that a private sector bank must have a minimum capital of 300 crores within a period of 3 years. I find public sector giants having capital from 400 crores to 1,500 crores. I find a private sector bank of the old genre having a measly capital of 12.5 crores. So there's absolutely, if there is anything that is consistent in this, it is heterogeneity and not homogeneity. You can have capital as low as 12.5 crores, you can have capital as big as 1,500 crores. Or more. I have not checked for State Bank of India. It should be more. Now, so there's no homogeneity. The lack of capital, does it pose a question mark over the existence or the future of banks? Now, since 1991, Iraq stands for Income Recognition and Asset Classification norms. These were introduced in 1991. Everybody cried wolf. Indian system cannot withstand this. All the borrowers will turn NPAs. There were only Nostradamuses. There were only doomsday soothsayers and nothing else. But we've overcome all that and we have moved to a 90-day norm wherein if you see the weighted average NPA portfolio of the banks, it will not exceed 1%, which is an acceptable risk level. The capitals are adequate, but capital adequacy norms, more recent in origin, as a concept, it restricts the overall exposure of the institution to the system. If you say 12% capital adequacy, you can lend only 8 times your net worth. So it restricts the exposure of the bank, and within which RBI has got sectoral exposures, not beyond so much for stockbrokers, not beyond so much for real estate. So there are inherent systems. So banks are well capitalized, adequately capitalized. There's a lot of flip side to the capital part of it. But whether the credit markets or the regulator, the Reserve Bank, or regulators world over, they are like Oliver Twist. They always ask for more. So there is no last word on that. But I think Indian banks are fairly well placed on this. Pro-cyclicalities, who ride the crest of the wave. What is wrong with it? And create buffers and save for the rainy day. Try to adopt good practices during the good times, during the boom times, and see that you have good control mechanisms in bad times. Pro-cyclicality tendencies need not be wished away. They are part of the system. DIC, Deposit Insurance Corporation. The present rate is 0.1%, 5 paise per 100 rupees per half year. Now the ASCB, or what we bankers call it as ASCB, Aggregate Scheduled Commercial Bank Deposits, is of the order of 676,000 crores as of a recent RBI report. Now 0.1% on this works out to 676 crores. I don't know what sort of a corpus is 676 crores to protect an economy of the size of India. Absolute peanuts. It's probably robbing Paul to pay Peter, because this subsidizes the credit part of it. This subsidizes the credit part of it. And look at the history. So far, since 1963, no bank, since the collapse, in fact, the DIC is a fallout of the collapse of the Pala Central Bank in 1963. No bank has been allowed to fail. I very consciously use the word allowed to fail. Banks have failed. A Nedungadi bank went belly up. It was merged with somebody else. A new Bank of India said, our game is up. Punjab National Bank was the suitor. A GTB had notorious credit practices. Nobody in Hyderabad worth his salt would touch any of their assets with a barge pole. And that was tagged on to Oriental Bank of Commerce. Banks have not been allowed to fail, not that they have not failed. Where is the loss of depositors' interest here? Where is the need to pay 0.1%? It probably subsidizes the credit part of it. I think the DIC as an institution is outdated, antediluvian. And it is living on borrowed time. And liquidity risk measures. Now the Reserve Bank, with due respect to the regulator, believes that CRR is the only mechanism by which liquidity can be expanded or controlled. Now, classical monetary economists believe that OMO, or open market operations, are equally an effective tool. I have seen CRR swing back and forth. The highest CRR under the Reserve Bank of India Act is 10%. 15%, sorry. But it has gone very close to that in certain times. and it has also fallen to sub 5%. So it has oscillated in a very big band. CRR has been used more as a monetary tool, but the essential purpose of CRR and SLR in days of non-NPA days was to protect the depositor's interest. When about 40-55% of the bank's funds are impounded by way of CRR and SLR, the depositor's funds are protected in a much bigger way than it would have been otherwise.
I think the war has started.
So I think that's one thing. Higher capital adequacy, cost of funds, economic growth, yes, it's a cycle. Credit markets move in cycles. Borrowers, bankers, lenders, syndication arrangers all have to live with the fact that when liquidity is tight, when market conditions are tight, you will have to have higher cost of funds. There's absolutely no running away from this fact. As recently as 2 years back, you were getting home loan calls for 7.75%. Today it has nearly doubled. So, or if not doubled, close to it. So interest rates move with cyclicalities. We'll have to take it with it. And strong banks are still capable of raising debt. And markets, when I say markets, equity markets, shun any institution, company or bank from visiting the markets frequently. So there is a limitation on what I can raise by way of equity capital. There is a much more stronger limitation as to what I can raise by way of reserves every year. Therefore, one option is to go in for Tier 2 subordinated debt to augment. But if that is